Let's stay with this because there are often so many questions that are being asked about, interest rates. Why are they being hiked? Why would they be paused? What influences some of the decisions to hike or to drop, the interest rate hikes? Or this, of course, as some economists are expecting the Reserve Bank to pause on interest rate hikes tomorrow. Let's try and simplify what all of this means for you right now with Professor Raymond Parsons from the Northwest University School of Business and Governance. Thank you so much, Prof, for your time. A number of consumers often ask, why would there be a need to hike or to pause or to drop interest rates? Because for them, they feel that if they're too high, then they're buckling under pressure. So let's help them try to understand.
Yes, good evening to you. Look, I think that the cycle of the actual rising interest rates has been going on since November 2021, and it reflects the Reserve Bank's mandate and concern about the escalating rates of inflation, which we got partly as a result of the Russia-Ukraine war, food prices, energy prices, some of the local factors that were pushing up inflation, which caused the bank then to embark on an interest rate raising cycle, which means that borrowing costs for both consumers and business people have now risen to their highest level in 14 years. Now, that's what's been happening in the past year or so. But we're now at a point where, as you've rightly pointed out, we've got much better news. Today, we heard that the CPI, or what we call the headline inflation, has fallen for the first time in some time to below 6%, and it's now within the target range of the Reserve Bank, which is one of the things that the Reserve Bank worries about. So that's why some economists have been saying, well, like a doctor who says to you, you must take your antibiotics for 5 days, even though you might feel better sooner, the Reserve Bank might take the attitude tomorrow that, yes, there's still one more hike to go, maybe about 25 basis points, just to round off the cycle and make sure that we have tamed inflation. But there's another strong view emerging that once you see inflation coming down, as it's coming down now, both globally and in South Africa, there's a strong case for the Reserve Bank tomorrow to offer us good news and say, well, we're going to pause. We're going to take stock of the overall situation, bearing in mind that we've been increasing interest rates for 18 months. So we need to look at what the time lag effect is. Secondly, we know we're in a weak economy. We know what the problems are around growth and unemployment, which are looking very weak for the rest of this year. And finally, as I said, the time lags. You can't just go on increasing interest rates in a mechanistic way. You want to bring your judgment to bear on the latest situation, and the latest situation is offering much better news than we've had for some months.
So, Prof, there's something else, though, that, some of the viewers would ask us from time to time is that when, you speak to economists about, issues around inflation, around the interest rate hikes and all of that, they talk about the importance of Fed movements and how those could be key for what happens in this regard. And that, of course, is in reference to the U.S. Federal Reserve. Why is this an important factor to consider?
Well, that is something that often features in the statements by the Monetary Policy Committee every 2 months. They keep an eagle eye on what's happening with interest rates abroad, but in particular in the United States, because that has an effect very much on the rest of the world, and particularly some of the emerging economies like South Africa. So we have to keep some differential between ourselves and what's happening with interest rates abroad. That doesn't mean to say that we have to follow them slavishly. And in fact, what the Federal Reserve itself did is what I've been saying now. At their last meeting, they also paused, although they don't think they've yet tamed inflation. In fact, they feel they still have some hikes to go. But they've said, let us pause and see what the effect is of what we've done so far. And that will influence whether we will decide to increase interest rates later. as far as the United States is concerned. So that is important for South Africa because we know that as the dollar goes, so does the rand. So we want to keep some kind of differential and some kind of management there. But we mustn't be slavish or follow it in a way that's purely automatic. We need to bring our judgment to bear on the total internal and external economic circumstances. And that's obviously what the Monetary Policy Committee will do tomorrow in deciding whether it'll have what I've called a hawkish pause at this point, or whether it must go, as the doctor says, you need another 25 basis points to make quite sure that even though you may be feeling a little better now, we get that virus out of your system. So I think that's the judgment call. It's not a purely technical exercise. It's the wisdom will lie in weighing up the pros and cons of what the Monetary Policy Committee will face tomorrow in having to make its decision.
We've seen calls in the past and also recently as well for the bank to look beyond interest rates to cushion some consumers, some in fact even in the past calling for its mandate to be broadened, and a lot of course a lot of people saying no, respect the independence of the sub. How important is the central bank's independence?
It's very important. It's important in all countries that a central bank has a degree of autonomy in deciding what monetary policy should be. That must be accompanied, of course, it must be transparent. There must be a robust debate. There are times when one might disagree with a particular decision, might be too aggressive in the circumstances, but that's part of the debate. But the more important long-run institutional thing is that we must respect the very high reputation and professionalism that our central bank brings to our monetary affairs. And we must couple it with the fact that you cannot look to monetary policy to solve all the problems. In fact, you might say today that the better news is on the inflation front and the worst news is on the load shedding front. So there are other structural issues which lie outside the mandate of the Reserve Bank, which we need to address urgently. And in fact, the more urgently and the more effectively we implement other structural issues, so we make the task of bringing down the costs of doing business, bringing down the costs to the consumer who goes into their shop and their shopping mall every day. We have to see it not only as something you put solely on the shoulders of a central bank or the Reserve Bank, but also on other decision makers who need to take very important key decisions to stabilize this economy and to bring inflation down to a more manageable level, because price stability in the long run is an essential requirement for getting growth and employment and getting shared prosperity in the years ahead.
Thank you very much, Prof, for that. Do appreciate it and do hope that, of course, the viewers have taken some of those nuggets there into consideration. That was Professor Raymond Parsons from the Northwest University School of Business and Governance. And this, of course, ahead of the decision by the Reserve Bank that is expected by some economists to pause on the interest rate hikes.